Welcome back to the Commodities Dig. I'm joined by David Garofalo, CEO of Hudbay Minerals. David, around March 31st, your cash and your working capital position was around $764 million and $661 million, respectively. Mm-hmm. And I believe from now until about 2016, your capital cost requirements will be around $1 billion. So with this in mind, do you have any cost management or spending cuts expected in the next little while?
No, in fact, it's the opposite. We're continuing to invest in new capacity. Okay. We're going from 1 to 4 mines. We do have additional financial capacity available to us. We still have another $135 million to draw under our Silver Wheaton facility. Right. We have $400 million of undrawn credit lines over and above the $764 million in cash you mentioned earlier on. And our cash flow is starting to increase as these projects reach capacity. So we'll have capital to put to work into new opportunities like Rosemont going forward.
Okay, and you mentioned your streaming arrangement with Silver Wheaton. So you've pursued recently all kinds of different financing options, streaming, debt. I know that you've signed some confidentiality agreements with some SOEs in Asia. In this market, are there any particular financing options you wouldn't pursue?
I would say equity right now is exceedingly expensive given the multiples are still quite depressed. There hasn't been an influx of new capital in the space for quite a bit of time. I think equity investors, at least the generalists, are focused on other sectors right now, like the REITs, like the energy sector. They're generating more superior rates of return there. So we're still a ways away from seeing the multiples back up to a level where equity becomes a viable source of capital.
What about private equity? We keep hearing about this $50 billion that's just sitting on the sidelines ready to jump in. Does that interest you at all? Do you think it's going to happen anytime soon?
That capital is there. I don't know if it's 50 billion, it might be 10 or 15 billion. Maybe it is 50. The numbers are all over the map. But I will say that the traditional private equity models typically doesn't work in the mining sector because of the long lead times to production, the high capital intensity up front. It's very difficult to generate the kinds of rates of return that those guys demand and to get the leverage in place that would allow them to generate those rates of return. So I don't see private equity ever having a meaningful role in the sector. There are some exceptions, like what X2 Resources is doing. That's not a traditional private equity model. They're actually looking to build a mining company, so they have more long-dated perspectives in terms of the rates of return. But by and large, the private equity model just doesn't work in the mining space for those reasons.
Really good for oil, but maybe not going to translate as well into mining.
Yeah, exactly. Oil, you mean you drill a well and you can get instant cash flow. You certainly can't get that kind of phenomenon in the mining sector.
Okay. And I guess my last question for you is, have you noticed any differences between the M&A market for late-stage exploration projects versus projects that are in production or just about to head into production? Is there a difference in the M&A market at all?
Yeah, I would characterize the current mining M&A market as surgical. It's not I wouldn't say it's a broad trend in M&A. I don't think there's going to be an influx of large-scale M&A. We've seen a lot of asset sales out of the seniors, whether it's North Parks or Eagle or Pinto Valley or Las Bambas. Those are individual assets that have been sold into the market. Those are either in production or near production, so not a lot of companies want to take the capital risk or the timing risk or execution risk associated with greenfield projects. And I think that's why we largely got a free ride on Augusta in terms of lack of competition. There's not a lot of companies out there, particularly large-scale companies that can do $1.5 billion projects, want greenfield projects right now, because their investors are demanding that capital come back in the form of dividends or share buybacks. Yeah,
so that's kind of your sweet spot. A good differentiator in the marketplace for you guys.
Well, that's right, and we should be building as a mid-tier company when the seniors are not. So we're not competing for scarce human resources or scarce inputs.
Right.
And so that's given us a bit of a free ride during the construction. We haven't had significant capital escalation in the 3 projects that we built because we've had access to those resources that we'd otherwise be competing for in a hotter market.
Okay, thank you so much for your time today.
All right.
I really enjoyed it. This is the Commodities Dig. I'm Amy Hogan. Until next time.